please welcome with me very loudly Onur Akpolat.
Cool. So you want to be a blockchain founder. Just to get a feel, who of you wants to be a blockchain founder or thinks about founding a blockchain company? Great. Who of you is a blockchain founder already? Okay, quite a few. How many of you are lawyers? Oh wow, there's quite a few, which is great, honestly. So yeah, I'm gonna talk a little bit about what I've seen, what it means being a blockchain founder over the last couple of years. And yeah, I'm gonna do a quick intro, talk a little bit about the problems that we're seeing and the program that we're offering at Interchain. So the most important thing about myself, I'm not a lawyer and I'm not a tax consultant and none of this is legal advice. It's just kind of things that we've seen working with the teams and how to kind of help them a little bit structure, navigate the complexity of this ecosystem. I'm a computer scientist by training, started actually with proof of work mining, getting into the space 6 years ago. Worked on a project on Ethereum called Radical, which is kind of working on decentralized code collaboration for some of the social primitives, and then joined Interchain 2 years ago, now working on the Builders program, basically working with teams on pretty much everything. But yeah, especially in the beginning, most importantly, legal and fundraising questions that just come up. So you want to be a blockchain founder, and the beginning is all fun, but this is no joke. Like we've seen a crazy amount of anxiety, especially as teams were approaching mainnet. There's just like this sheer amount of uncertainty when it comes to token generation event and launching a chain and all the kind of legal implications and tax implications that it's really scary. And yeah, I'm gonna start with that. Kind of, you want to be a blockchain founder, you want to kind of start a company, and like with any other company, there's usually two main problems that you want to solve. The first one is kind of limiting legal liability. That's why you put an entity in place. And the second one is somewhat controlling your tax liability. Now, when you do kind of a Web2 startup, you know, and you live in the US, for example, usually you go with a Delaware C Corp. This has been done a million times. There are playbooks for this. There's even like Stripe Atlas, I think, which makes this really, really easy. And there's kind of a certain way on how to achieve this. If you're planning on issuing a token, it's not that easy. It's definitely not that easy. Basically, most of the time you need, first of all, not just one, but a couple different entities. And a common thing we've seen is if you're planning to launch a network, basically to limit liability and build like a wrapper for anything that happens in the network, there's some sort of entity without beneficiary owners. And you know, a few examples of this are foundations or maybe sometimes associations and these type of companies. We've seen a lot of Swiss foundations, for example, but we've also seen something like Cayman Foundation companies and all these type of structures. So these entities usually aim to not have beneficiary owners, and either those entities can do a token issuance directly, or they have another entity which they own, which is the token issuer, and the token's issuer's purpose is to kind of ring fence all the liability that comes with doing a token issuance, usually towards token acquirers. So whenever you do like a sale or something like that, you want to have another entity in place that kind of limits the liability in that regard. Again, there's like a ton of different variations here, which is I'm not going to go into like specifics, but usually if you work with a law firm, you will end up some version of that. But then you have kind of real life like fiat costs. You need to pay an office, you need to pay employees, you want to hire people, which is why you need kind of a devco in the first place, a development company. And that is just a normal company. It can be a C Corp in Delaware, it can be a company in Europe or in Switzerland, in AG, wherever you live, whatever you want. And yeah, so this is kind of one of the ways how you can structure projects when you do token issuance. And we kind of educate the teams on what options exist, but we also help to connect them with real lawyers who can kind of help them to implement these type of structures. Fundraising is kind of the next thing. And again, going back to the Web2 example, if you're fundraising in a normal company, Most of the time, the things I've seen is a simple equity round based on a pre and a post-money valuation. You go ahead and raise the funds, and everything is done. In our space, when you do token issuance, there's not just the equity, but there's also potentially a token in the future, which is something investors are interested in. So one of the simple things most people probably heard is something called a SAFT, a simple agreement for future token. This is something like, I'm going to have 50 million token, I'm selling one token for $1, my network is fully diluted, valued at $50 million, and you can purchase one if you want. So that is the SAFT. And while it's super simple, it might not be the most favorable for you in terms of where you live, the jurisdiction that you live, and kind of the distribution method you have for your token. And I'm going to dive into that in a second, why this is super important. Just to mention a few others, there's SAFE, simple agreement for future equity. There's even, for a time, there was a SAFET, which is something like a simple agreement for future token or equity. There's SAFEs with token warrants or token side letters, which are basically, you're getting equity, but on top of that, there's some sort of like conversion mostly defined to a future token, which is the side letter, the warrant. And there's something like a classical convertible loan, which means you're getting a loan, and then again, there's going to be some priced event in the future, and in that time, there's going to be a conversion that is defined. Now, why is that important? The reason this is important is if you do a SAFT, then you're pretty much pricing the network from an investment perspective. So you put a hard price on your network. And the reason you don't want to necessarily do that is, for example, when you're planning an internal token distribution to advisors and to team and things like that, if you're pricing the network at a 50 million, for example, and let's just take that example as the token as a network price, and you want to allocate 1% to a founder, that is worth 500,000, and that creates a 500,000 worth tax liability based on the jurisdiction that you live in, and this is what you want to avoid. Another thing is, in most jurisdictions, it's more favorable to purchase the tokens with regards to a future exit rather than being given tokens, because when you're given tokens, they're most of the time, not always, but most of the time subject to income tax. But when you purchase tokens in the future, they will be subject to some version of capital gain tax, which is why it's more favorable to purchase the tokens. But I mean, who can purchase tokens worth 500K if you price the network? So this is why you want to be thoughtful as a founder with how you raise, as it's going to have an implication on the network value, which will have an implication on the allocation, which will have an implication on the taxes of the team, and so on and so forth. This is kind of what I just explained. But how do you achieve actually a low valuation? Like what is the network worth pre-launch, despite fundraising? So this is kind of the dance you're trying to do. You're trying to kind of raise, if you have capital needs and you want to raise from investors and you make that decision, then you need to kind of balance how are you raising, and how do you make sure the kind of valuation of your software is kind of efficient enough to do an allocation. And one thing that we recommend teams to do is to do kind of a third-party audit. First of all, we recommend to raise thoughtfully with the right instruments, but then we recommend to do a third-party audit, which means a company comes in and puts a price on the software or on the future network. And how do they do that? So first of all, they need to define a methodology on how this valuation is being done. If there's like very similar projects, they can do lookalikes and look at revenue. But since in our space that doesn't really exist, one common way to do that is actually do a cost basis approach. And that means you look at all the costs that went into creating this software that is going to run the network in the future. And then you can say something like, 2 or 3 people have been working on this for a couple months. Maybe there's some sunk costs. But essentially, we value this software to be worth, let's say, 50K. And if you didn't price the network before, and you now have a third-party audit that says your software is worth 50K, then you can do a board meeting, you can do a decision and prepare a memo that states that. And based on that, now you're much more flexible to allocate tokens internally. For example, again, if a founder purchased 1% worth on a 50K valuation, all of a sudden that's just 500. And even if it's a little bit higher, even if the valuation is 200-300K, you can still balance that out with loans that the company gives you in order to purchase that. And this is just like ways we at least like educate teams, hey, like these things are possible. You don't have to do any of these things, but like if you do it like that, based on the jurisdiction that you live in, we usually connect them with the tax advisors. These are kind of scenarios how you could structure those things. Deployment of funds is another question that comes up over and over again, and this heavily kind of depends on the previous structure of how you've raised in the first place. But assuming you've raised including crypto assets, and maybe some foundations in some jurisdictions that don't even have bank accounts, there's like certain problems you need to solve. The first problem you need to solve is how do you get funds from, for example, the foundation to the DevCo? Because the DevCo is not really affiliated with the foundation. It's just kind of a normal entity that you've built to employ people to cover salaries and everything. A simple thing is a service agreement. A service agreement is a contract with kind of clear milestones and deliverables for a certain time period, let's say for a year or 12 months. And yeah, that is something simple you can do. A grant also works. It's a bit easier and simpler. You can also model grants to be fully on-chain, but it only works for reasonably small amounts. I haven't seen grants worth millions. That might be much more complicated. But let's say you have a DevCo, and then that DevCo receives, Atom or Osmo from a foundation or something like that. And yeah, how do you basically off-ramp that, right? So this is kind of where, again, based on the jurisdiction, where we help teams to work with banking partners that understand how this works. In Switzerland, for example, there are a few that are quite progressed in that regard. And basically understand, prepare the AML of where the funds are coming from, and help the teams to offboard those funds into cash reserves. But again, if you start out being a crypto founder, you're not thinking about any of this. Especially, most technical founders that we've worked with jump right into coding, super sufficient with the SDK or their Rust and the WASM contracts. But this stuff is so distracting that it usually kills the momentum a lot, especially when this expertise is not present in teams at all. Which is why, again, with the Builders program, these are some of the things that we're trying to help the teams with. And yeah, so basically, what do we do? We do two things essentially. We help the teams to navigate not just like the Cosmos ecosystem complexity itself, which is complex enough, but also like all the legal and complexity in the different jurisdictions. And at the same time, kind of we make them aware of the fundraising implications, because this is one of the first things that the teams do. And this is also one of the things that is mostly informed by the investor's preference, and one of the things that the teams just want to get over to have the funds in the bank account. But it might make sense to just like take a step back and kind of evaluate. Okay, what else do we do? So I was talking a lot about the first green bubble, the legal and fundraising part, which again, not being lawyers, we just help the teams to connect them to the right partners. But what we also do is we help the teams to scope the projects, to not make a six-figure legal consulting project, but maybe like help the teams to scope the project in a better way and kind of define the clear goals together with the law firms. We have engineers in the team, so we help them with their architecture, their tech, and generally their product, mostly if they're using the Cosmos SDK directly and working with the SDK, but also if they're using WASM. We help them with kind of their infrastructure and partnerships play, and this really depends on the team's preference on how they want to bootstrap and launch their network. If they're going kind of the classical route of securing their own network with their own validator set, then we help them to kind of make connections to all the existing validators, or maybe to design their testnet, potentially design incentives around that, if that makes sense. But maybe, maybe teams these days don't want to do that anymore. Maybe they want to more bet on something like Interchain security, which is when we educate them on how to utilize Interchain security to build their own consumer chain. But even if projects, especially these days, if they're working with WASM and they just want to deploy on another environment like Juno or Osmosis, I was going to say the hub, but Prop 69. Then we help them, and we basically show them of ways on how to secure the network. Same with marketing and go-to-market. Same with community and governance. Potentially tokenomics if that's interesting, but these are usually areas that the teams have a very good grasp on. But again, like especially in the beginning, we feel like this always comes up as the first thing that is just like super complex, and it changes all the time, by the way. Like the structure that I just showed today is probably not going to look the same in a year or two from now. Cool. So, Builders Program. I mean, we've been doing this week. We've been doing this work in the background for 6 months already with kind of selected teams in our network, but we're finally there to kind of make this more public. This is a sneak peek of the website, the Builders Program. And yeah, we're going to release it in the next couple of weeks. It's almost done. And yeah, if you're kind of a team working out in the space and you want to get help with some of these areas, feel free to reach out to us. You can get in touch with me. Here's my email. And cool. See you all around.
Thank you, Onur. I have 2 questions for you, if you don't mind.
Of course, yeah.
Yeah, the first question is, if you would need to choose one country to launch a crypto project in, which one would it be?
It depends on where the founders or where the team lives. So, and there's definitely no silver bullet to answer that question, but I'm just going to give like 2 examples. If the team lives in the US, one thing that I don't recommend, but that I've seen is a Cayman Foundation company with a BVI, British Virgin Island token issuer, and then just a Delaware LLC or LTD DevCo. This is kind of a setup that was pretty common. I'm not sure, but I think it was somewhat like popularized by Fenwick, amongst others. Fenwick is a law firm. If you are in Europe, I mean, I would at least consider Swiss and Liechtenstein foundations. Although, the financial market regulator in Switzerland, which is FINMA, definitely got way more strict over the past. So I think Switzerland might be too strict these days. Maybe Liechtenstein is an alternative, but these are usually jurisdictions that come up in Asia. I think Korea is probably still an option, and Singapore. Singapore is definitely, especially for the foundation, something that we're still seeing a lot.
Got you. And another question is, do you think it's good to start out as a DAO from day one?
Depends on what you mean by a DAO. But if you're referring to the governance, I would say yes. Because the more decisions founders make, the less favorable it will be from hey, this is a decentralized thing without beneficiary owners. So for example, to give you one concrete example, I've seen many token issuances recently with something like an LBP, where the founding team was completely absent. They just launched a DAO with the legal wrapper, and then some community members proposed to do an LBP on chain, and they voted themselves. And it was encoded and directly executed on chain that a certain percentage of tokens were submitted to a pool to do a distribution via LBP. There, because it was a DAO, the founders were not involved. I think it's a good place to justify that you didn't do a centralized token sale, if that's what you're going for. If you're not a DAO from day one, you can also do it. But yeah, you need to be very careful who you raise from and how you do it if you're raising publicly.
Yeah, 100%. And last question, it's about the Builders Program. Are there any requirements for becoming a part of the program?
Yes, there are. So our requirements today are that you're using some piece of the Cosmos stack, which is either a Tendermint or the Cosmos SDK. But even if you're using WASM, we definitely consider that part of the stack. So this is kind of the base requirement. Another requirement, which is not really kind of made explicit yet, is we're looking for projects that are slightly beyond idea stage. So if you're just having an idea, that's great, and we would encourage everyone to kind of pursue that and kind of keep working on the idea. But we're definitely looking for founding teams that are already kind of mitigated team risk, have shown that they can kind of put together the team and that we can just support executing on their idea and plan.
Sounds good. So, a big applause, please, for Onur Akpolat.